Good afternoon, everyone. Welcome to this outstanding refresher course and look forward on the future of the child tax credit with one of the biggest experts in the business from the Bipartisan Policy Center and yours truly. I'm Pete Sepp, president of National Taxpayers Union and National Taxpayers Union Foundation. I want to thank all of you out there for attending this very important discussion. We are hoping that the words that we exchange today will provide the basis for a bipartisan path forward on several important tax relief provisions, not only the child tax credit, but also important business provisions that can be paired with the child tax credit for a year-end tax package. Yes, folks, we do think it is still possible in the remaining days of December for Congress to push forward a tax package that will provide relief for families and businesses across the United States. So I have here Andrew Lautz, Senior Policy Analyst for the Bipartisan Policy Center and a familiar face to NTU and NTU Foundation because he used to work here. And I think that we have some great opportunities for serendipity and bipartisan cooperation over these issues. Welcome to our humble little online abode, Andrew.
Thanks, Pete. Really great to be back talking with you and with NTUF's extended network again. I spent 4 great years at NTU and NTU Foundation, and I know how hard you all fight for taxpayers every day.
Well, we're really glad to connect again and do good work, as the late, great John Glenn said when he was asked, as an astronaut, what do you think America should do to get into space? He said, do good work. Well, we're going to take those words to heart and figure out how we can get this tax relief package off the launching pad. So, Andrew, how about you set the stage a little bit over the state of play regarding an end-of-year tax package that includes both an enhancement to the child tax credit and potentially a fix to the R&D issue, perhaps even the 1099-K issue?
Happy to, Pete. So it is December 5th. There are 26 days left in the calendar year, and there are just 6 days left where both chambers of Congress, House and Senate, are in session. Now, you don't need to be one of the key negotiators on Capitol Hill to know that 6 days is not a lot of time to negotiate a tax package that could reduce revenues by upwards of $100 billion over 10 years. And that's kind of the package that we're looking at. Between the child tax credit on the one end and some of the business tax provisions on the other. Let me just really quickly review 3 things we know and 3 things we don't know as we talk about a year-end tax deal, so to speak. 3 things we know. First, any tax deal will likely center on, as you mentioned, Pete, a child tax credit expansion as the top ask coming from Democrats, and a number of business tax policies as the top ask for Republicans. All of these are related to some of the business tax changes made by the 2017 Tax Cuts and Jobs Act. We can certainly get into more detail on all 3 as you please. Second thing we know, any tax deal is most likely only going to address these policies for 2 years. 2024 and 2025. That's both because the cost of permanent policies, the revenue impact of them is much higher on a permanent basis than for just 2 years. So the math problem becomes more difficult if you're trying to make permanent policy. And the second more practical reason is because 2025 is when everything on the table, as Chairman Jason Smith on the Ways and Means Committee has put it is the Super Bowl of tax in 2025. And so everything is sort of lining up to be considered in that one calendar year. And then third, any tax deal is probably going to need to be part of some other piece of legislation. It is not likely to go forward solely on its own as a tax-only bill. It's probably going to be attached to some other piece of legislation. Now, 3 things we don't know. We don't know what lawmakers will propose doing to the CTC. As we'll discuss over the course of the webinar, there are so many levers to push and pull here, and each lever affects who gets more CTC versus the same amount of CTC. It impacts the economic and labor market effects of an expanded CTC and more. Second thing we don't know whether additional tax policies will get addressed. The low-income housing tax credit is on the table and the product of a lot of bipartisan work between Republicans and Democrats right now. The state and local tax deduction, or SALT, is a famously contentious tax issue and has been bandied about by both parties for the last several years. The 1099-K tax administration issue, these are the forms that you're scheduled to get or were scheduled to get until the IRS took administrative action. If you sell used goods online on eBay, or if you sell concert tickets or game tickets on Ticketmaster, we don't know if these additional tax policies will be part of that package. And then the third thing we don't know is whether a tax deal would have the requisite support in Congress to actually get through. I think Democrats will be looking for a sufficient expansion of the CTC to low-income families, specifically, not just to middle and upper-income families. And Republicans, of course, will be looking to for the inclusion of all three business tax policies they're hoping to address: tax treatment of research and development, tax treatment of assets like machinery and equipment, and limits on the deductibility of interest. Now, a wild card possibility on all of this is a year-end tax deal. I use the term year-end in quotes, actually being addressed in January or February. This is because tax titles, when they have come together in recent years, they've more often been tied to appropriations bills than to other high priority items in Congress, like the defense authorization bill, for example. We have two continuing resolutions. These are stopgap bills that prevented the government from shutting down. One expires on January 19th. The other expires on February 2nd, 2 weeks later. Could these bills carry a tax title? Maybe. There are some challenges associated with the retroactivity of changes to R&D deductions in particular for businesses, but these challenges shouldn't be insurmountable if the political will is there. So that's sort of the state of play. Happy to discuss as you see fit, but the short answer is I don't know whether Congress will address tax policy in the next couple of months, but we sure hope they do at the Bipartisan Policy Center.
Yes, we certainly share that hope here at National Taxpayers Union. And let me just add a couple of points to your excellent summary, Andrew. First, we do have the fact that the IRS has apparently taken the 1099-K issue off the table for another year. It would sure be good if Congress would actually speak with a voice on this issue, since they were the ones who enacted this burdensome administrative and revenue-raising provision a couple of years ago. And we could sure use the clarity from bipartisan legislation. And in fact, this is part of our no-brainers list that we recently issued just Monday, actually, in regards to bills that Congress can pass that are of a bipartisan nature, that shouldn't be hugely controversial, but would be tremendously helpful to taxpayers. There is indeed such legislation in a variety of forms. Sherrod Brown, senator from Ohio, has a proposal. So does Todd Young of Indiana. There are others involved with the research and development expensing that has now fallen into 5-year amortization. Sounds complex, but basically you could fully deduct that until 2022. It hasn't been deductible on a real-time, full annual basis since then. You have to amortize it over 5 years. In 2023, full expensing for other types of items expired, and now the expensing is being reduced by 20% a year until that also falls into a new category of complexity. And the interest expense that has come back under new limits since some relief enacted in 2021 expired. All of these things are conspiring, along with the fact that the child tax credit, which was expanded under the 2017 law, expanded again under the 2021 ARPA law, but that's again also fallen back in terms of certain levels of benefits and how the benefits are paid out. And so these things need to be addressed before that big Super Bowl of 2025 because they've already been set into motion and taxpayers are not benefiting from the laws in the way they were intended at least a few years ago. But we've got to figure out a way to do this sustainably. And that's the challenge. You know, we have the long-term issue and the short-term issue. Short term, what are we going to do to provide a good dose of relief for the next 2 years, as you described? And what are we going to do over the longer term horizon to ensure that these provisions keep working for taxpayers without absolutely crushing the federal deficit over time? So big challenges. And I would add also on the encouraging part of the near-term horizon, there was a letter very recently sent to Speaker Johnson. In fact, that was last week, from upwards of 150 GOP lawmakers who are not sitting on the House Ways and Means Committee, urging the Speaker to move forward with a tax relief package. Now, the Republican letter does not mention the child tax credit. It's more focused on this Build in America Act. But again, you see the genesis of a deal here that can leave everybody with something to walk away from the table with and say to their constituents, we moved the ball forward. Keep mixing analogies here, but I guess that applies to Super Bowl lingo. What do you think, Andrew, when we look now, and you pointed out, it's not just a matter of a month left in this Congress. There are only a handful of days when they will actually be doing floor work where this could move forward. But you make an intriguing point that what if this does drag on into January and we get a deal then? The IRS generally makes updates to its forms and website about now, and in fact will have completed them probably within another week or so to plan ahead for next year's filing season. But they can also put their finger to the wind as well and see that if something's brewing in Congress, they can leave open some of their systems to very quickly update them, perhaps push the filing season off a little bit from mid-January to the end of January in order to make changes. I'm trying to think here, though, what is probably the maximum time that Congress could possibly have to make an impactful change for 2024? Are we talking early January, mid-January?
I think this is a space where reasonable people can disagree, Pete. But I would say February 2nd is sort of
Yeah.
that second continuing resolution deadline is
Yeah.
a maybe not a hard deadline, but a pretty strong soft deadline for the realistic chance Congress has to get a tax deal done. There are administrative concerns, as you point out, with IRS systems and just with how taxpayers, especially how business taxpayers, sort of handle quarterly payments. There are a number of administrative concerns. There's also, I think, the more relevant obstacle is the political one. We are headed towards a major election year. It's not like Congress will shut down and stop working in February, but the closer and closer we get to November, the less and less serious, sober, bipartisan legislating we expect there to be in Congress. There will certainly be bipartisan opportunities well into 2024, and there are legislative deadlines that Congress needs to address. For example, the Farm Bill got a 1-year extension by the latest continuing resolution and expires September 30th, 2024. There's also the small matter of Congress's doing its job on appropriations, and they will have another cycle of appropriations bills that come with an October 1st deadline in 2024. So there are legislative opportunities, but the election and all of the campaigning involved from both parties will make it difficult, I think, post this February deadline to get something done on tax policy. I also just want to highlight and pull out what you said on the um, the fiscal responsibility of it all, and how we sort of manage all of the coming tax policy expirations and the need to pay for them. 2025 is going to be just a gigantic fiscal year for fiscal policy. You have the debt limit expiring, or the suspension of the debt limit expiring, I should say, in the first half of January. We are going to, or the first half of 2025. Second half of 2025, we are almost certainly going to be talking about these trillions of dollars in tax cut expirations. I would point viewers of this webinar to our great friends at Tax Foundation, who have put out some really stellar work trying to put numbers on just how big of a fiscal question these TCJA expirations are in 2025, and there are a lot of assumptions that go into that, and what is on the table, what are Republicans and Democrats actually negotiating in 2025. It's more than just what is in the Tax Cuts and Jobs Act if we're in a situation of divided government, but it is easily a multi-trillion-dollar question. And so we are going to be spending a lot of time at Bipartisan Policy Center over the next few years thinking about how can Congress address in a bipartisan fashion the portions of TCJA that they want to extend, the portions of TCJA that help grow our economy, that support workers and their families, while also ensuring that this extension doesn't blow a gigantic hole in our fiscal trajectory, which is already trending in absolutely the wrong direction. We don't want to make it substantially worse, and that is a very real risk to the 2025 extension discussion that is just about 12 months away from us now.
Yeah, and for Congress, 12 months is the blink of an eye, I'm afraid. So it's good that we're talking about these issues right here and right now. In fact, we've both been talking about them for far more months before today. So I guess it would be helpful if we just took a quick step back. We know how we got here. We know what our options might be in the intermediate and long term, but how did this all start? The child tax credit, for example, is a relatively young tax policy, having been around for roughly 25 years now. And it began as a $1,000 credit with relatively strict income phase outs. Relatively, I would say. It was conceived originally to help offset some of the long-term effects of inflation. We both know that much of the federal income tax code has been indexed for inflation so that bracket creep doesn't push people into higher taxes simply because they're keeping up with the cost of living. That's been in existence since 1981, took a hiatus for tax reform, but prior to 1981, there were decades of inflation that eroded the value of middle-class protections from taxes at the federal level. And the child tax credit was intended partially to address that. Started out at $1,000. The Tax Cuts and Jobs Act in 2017 boosted it to $2,000, and then raised the income thresholds at which it could be claimed, partly to address the offset of the fact that the personal exemption was going away. The American Rescue Plan Act boosted that credit to $3,000 with a new special credit for younger children, gave an extra year on the eligibility age, introduced a system whereby the refundable portion could actually be paid out monthly rather than having parents wait a whole year to get the money, which was often a terrible strain on lower income families when you're trying to make rent and pay for groceries and the like. And I think you made an excellent point about, as these adjustments have been made, the fiscal impact has gotten way bigger. I know in the paper that NTUF put out that you had a big hand in when you were here, that pointed out that the early child tax credit was something on the order of a $55 billion a year budget impact. Then the 2017 law, which augmented it, kind of boosted the impact to about 125 billion a year. ARPA to 180 billion a year. So it really matters where you set the baseline for any types of changes or reforms going forward.
I couldn't agree more, and I think you brought us through sort of a helpful and brief tour of the history of this credit, and it has a bipartisan history. That's something that naturally we emphasize at BPC all the time. As you mentioned, Pete, it was created in 1997. I can't speak to personal experience on the creation of the child tax credit because I was 4 years old when it was created, but I can assure you my parents were thankful to have that credit when me and my two younger brothers were growing up. But it was just $400 per child back then. That's about $750 in today's dollars to kind of put it in the current context. So even adjusting for inflation, the credit has significantly grown in the last 25 years, and it has actually been under Republican administrations and sometimes Republican Congresses where we have seen the per child amount grow. It was during the Bush administration that the credit went from $500 per child to $1,000 per child, and that was eventually made. It was originally temporary policy. The $1,000 per child credit eventually became permanent policy, and it was during the Trump administration, the Republican Congress in 2017, when TCJA doubled the per child amount from $1,000 to $2,000 per child. What we've seen from Democratic administrations and from Democratic lawmakers, and I think this is reflected in the American Rescue Plan, is a focus on trying to get more credit dollars to low-income families. So during the Obama administration, I think the major changes you were seeing to the base amount of the child tax credit actually didn't change during the Obama administration. They didn't tinker with it. What they did change in a series of tax laws over those 8 years was the basically the threshold at which you start as a parent, you start earning CTC on your annual tax filing. It originally, that earned income threshold was $8,500 when I believe when Obama started his tenure in 2009, and it was eventually lowered to $3,000. Something that's sometimes forgotten in the debate is Republicans actually agreed to a further lowering of that threshold in TCJA from $3,000 to $2,500 per child. And then, of course, the American Rescue Plan is and the Biden administration's proposal in 2021 is what I think really blew open the door on the CTC. And I don't say that in either a positive or a negative sense, but it was certainly from a fiscal perspective, it was the most significant expansion to the child tax credit in its history. And you also saw really unique ways of delivering the credit, this advance monthly basis for the first time. You saw the earnings threshold eliminated, the credit made fully refundable, meaning any parent could claim the full credit regardless of earnings. Of course, the catch with these changes in the American Rescue Plan is they were put into effect for only 1 year, 2021. And so, you've seen, I think there was a lot of taxpayer confusion around that. Taxpayers who didn't realize that this was a 1-year policy, that come 2022, they're wondering why their tax refunds are $1,000 less than they were the year prior. There's also been this regular push among Democrats to extend the expansion of the CTC, but as you sort of pointed out, Pete, that proponents of expanding the child tax credit, like Democrats did in the American Rescue Plan, do need to grapple with the fact that this is that proposal specifically is a very expensive expansion. Congressional Budget Office, I believe, at one point scored permanent policy like the American Rescue Plan CTC at just under $2 trillion over 10 years, and that number undoubtedly would be higher today because you have Congressional Budget Office baseline, including the $2,000 credit for the CTC for the next couple of years, but those years are starting to dwindle. And so the baseline starting in 2026 is $1,000 per child on the CTC. And so the cost of going from the federal cost, the revenue cost of going from $1,000 per child to $3,000 per child is obviously significantly more than going from $2,000 per child to $3,000 per child. And so, lawmakers who are proposing these CTC expansions certainly do need to grapple with the fiscal impact. I think one proposal where you have seen a group of lawmakers taking seriously that fiscal impact of expansion, but still supporting expansion of the credit is Senator Romney's proposal, where he has actually proposed offsets to it. Of course, the NTU proposal includes offsets. We at BPC believe that if you're significantly cutting taxes or if you're significantly increasing spending, that should be offset with either spending cuts or tax increases where appropriate. And so that's an important principle that lawmakers should keep in mind. But this credit, it has certainly evolved tremendously in the last 25 years. And it certainly means differently to parents than it did probably when it was created in the late 1990s.
Well, and that's, I think, an excellent jumping off point here as to why this credit is so important to so many people and why we have to figure out a way to keep it as generous as we can while keeping it as sustainable as we can. And Bipartisan Policy Center actually published an interesting paper on the trade-offs involved with the child tax credit just in September, I believe, right?
Mm-hmm.
Yes.
That's right. And we published this paper, and we've actually done subsequent research as well on the same topic, because it is a key impediment to a bipartisan deal on the child tax credit. Republicans have concerns, and based on our research, we believe they are justifiable concerns about the impact that a greatly, significantly expanded CTC might have on the labor market in the United States. And you have some Democrats. I think you have some Republicans who have. There are a number of academic studies on this, and this was sort of the one of the points of our studies was to compare and contrast what academics have had to say on this topic. But you have a choose your own adventure quality to the question of how much job loss or job gain theoretically we would see from an expanded CTC, depending on how you expand the CTC. And so that was sort of the point of the study, but we see it just to circle back on my original point. We see that as a key impediment to a deal. That if you can convince Democrats that there are indeed negative work effects to a greatly expanded CTC, and that you can design the CTC so that it mitigates the harm, the negative harm on the labor market. You can potentially work a deal from that side. And then from the Republican side, if you can convince Republican staff and members of Congress that, yes, there are negative work effects to a greatly expanded CTC, but if you do a more targeted, tailored expansion, you can actually still expand the credit to low-income families while mitigating or potentially eliminating negative work incentives, then you can potentially bring Republicans to the table on a deal. That is why we did this study, and happy to discuss those results more. But that is kind of the brief overview of what the study is and why we did it.
Yes, indeed. We will discuss those results some more. And I would like to invite anyone participating in this webinar to certainly join the discussion. You can use the Zoom function of adding a question. We will be happy to take those and answer them as best we can as we continue our conversation here. Thank you all again for joining us. So I guess we need to get down to some brass tacks, Andrew. You framed it so well about how we need to convince Democrats of one set of arguments and Republicans of another set of arguments. So we need to square the circle. What kind of deal could we possibly get here? I'll start the conversation by saying that NTU Foundation had a proposal on the table that kind of borrows from both TCJA and ARPA and even pre-TCJA law to come up with something that we think ought to be the starting point for discussion. We would have a $2,000 per child tax credit, along with a new $2,400 credit for younger children, 0 to age 5. We would borrow from previous plans in terms of reducing the income eligibility phase outs. In other words, TCJA set them at $200,000 for a single head of household, $400,000 for joint filers. We believe that despite the fact that the personal exemption has been done away with, we've got to make some kind of concession on those income thresholds, and we would restore them to $75,000 for a single household, $150,000 for a joint filing household. That's going to hurt a little bit. But again, if we want this credit to be around for years to come, with some kind of sustainability and a reasonably reduced impact on the federal deficit, we got to make choices like these. The 17-year-old eligibility limit for the credit, we would take down to 16. We would, however, index refundability and make a concession for the fact that having a relatively modest earned income level is pretty important, because that earned income eligibility that you have doesn't include a lot of the cash benefit programs. And so you could have many families, millions, in fact, who might fall out of eligibility if you don't try and maintain that provision. What else do we need to be thinking about when trying to close the deal? What is it that could set off Republicans versus setting off Democrats? I'm thinking the income eligibility might be a problem for Republicans. The amount might be a problem for Democrats. But what else are sort of the hidden problems that could come up during negotiations?
Ooh, it's a good question, Pete.
That's a tough one.
Yeah, and honestly, our thinking on the various policy levers has evolved over time at BPC, and I don't say that in a negative sense. It's I know a term like evolve can be risky in the political and policy world, because people can accuse you of flip-flopping, or no, we're actually we've been absorbing a lot of research over the last few years. We have been talking with policy experts and academics from sort of all over the ideological spectrum, all over the country, to get a better understanding of the history of the child tax credit, of the 2021 expansion, which of course so many people have put so much research and spilled so much ink on, and justifiably so, because it was a significant expansion of the credit that had an impact on millions of parents. Here's where our recent thinking is, and here are where I think where I think you could actually see lawmakers come together on a deal. That's kind of like the inverse of your question. You asked where the sticking points would be, and I want to get to that, but I want to focus on the glass half full part first, and where I think you could see lawmakers come together. I think you could see them come together on a small or targeted expansion to the base amount of the credit. I don't think, if there is a bipartisan deal in the coming months on the child tax credit, I don't think you're going to see a $3,000 per child credit like we saw during the American Rescue Plan. But could you see the base amount adjusted for inflation, for example, especially in a time where we've had record high or notably high inflation, the highest inflation in a generation over the last couple of years? I think that is a possibility that could bring the two parties together. You're not going to see something like the American Rescue Plan, where the credit was fully available to all parents regardless of earnings, but where you could see the two parties come together is adjusting the phase-in of the credit. Right now, the TCJA law is that starting at $2,500 in earnings, that's whether you're one parent or whether you're a two-parent household, starting at $2,500 in earnings, the credit phases in on a per child basis. So if you have 3 children, it would be one child and then the second child and then the third child at a 15% rate. So that means every $1,000 of earnings you are gaining $150 in child tax credit. So you could see lawmakers come together on reforms to that phase-in. Right now, the earnings threshold is $2,500. Could you see lawmakers agree to reduce that to $1, so that starting on the first dollar of earnings, parents are able to earn child tax credit? That would be, for example, a household with $2,000 in earnings under that policy would and one child would be getting a $300 tax credit, whereas right now they get 0, and that can make a meaningful difference for low-income families. Can you increase the phase-in rates? Right now it's 15%. Could you see something closer to some of the phase-in rates we see for the earned income tax credit, something like 30%? You could see lawmakers, I think, come together on increasing the phase-in rates. Refundability. Democrats and Republicans, this is, and sometimes the refundability argument gets lumped in with the earned income threshold argument. So I do take care to at least verbally separate the two. But in terms of the refundability of the credit, the Democrats and Republicans are actually not far off in terms of the policies they support. Most Democrats support a fully refundable CTC. So that means you get the full $2,000 per child credit, even if you have less than $2,000 of federal income tax liability. And Republicans, essentially, their current policy is 80% refundability, right. $1,600 of the $2,000. It should be feasible to bridge that gap between 80% and 100%. That is not a huge gap, I think, for the two parties to breach. Where I think you could see, where I don't think you'll see as much progress between the two parties, or where I don't think we'll return to vis-a-vis 2021 policy. I don't think anyone is talking about the advanceability of the credit, providing it on an advanced monthly basis. That has kind of dropped out of the conversation. Per National Taxpayers Union plan and also Bipartisan Policy Center's 2021 plan for expanding the CTC, I still see value in providing the option to parents, and that is something I think we should explore over the longer term. But it's not going to be a part of any short-term deal. I think Republicans have made clear one of their lines in the sand, or one of their only lines in the sand, perhaps their only line in the sand on CTC, is that they need to retain some kind of earnings or work requirement with the credit. So again, we're not going to see it move to fully available CTC regardless of earnings. One topic we haven't discussed as much in this conversation, but I'll be interested to see what, if any, momentum there is around it, is the bonus credit for young children. Yes. I'm not really sure where lawmakers would settle on that question, but that was obviously a significant difference and addition in the Democrats' plan and American Rescue Plan child tax credit that was never sort of implemented or explicitly supported by Republicans. And so to see where the two parties come together on that, I think if a deal comes together in the next few months, will be interesting. I'm not sure where the cards fall.
Yeah, I'd have to agree with that. And you start running numbers too on the intermediate term impacts of these proposals. I know that our friends at Tax Foundation scored the NTUF proposal, and the original parameters I outlined, it came in at a little over $700 billion over 10 years. If you were to do things like permanently repealing the dependent exemption, you would get it down to less than $200 billion over 10 years. Repeal the child and dependent care tax credit, you're at about $100 billion over 10 years. But again, we're not talking about intermediate or long term here, at least. And yet I can't help but express some regret over what gets left on the cutting room floor. You think, if this conversation were taking place in July, for example, right before they were headed out for their recess, the committees might have been able to do some work on some really important things, like perhaps having refundability and payments on a quarterly basis or a voluntary basis. You could explore harmonizing the definition of a child for purposes of both the child tax credit and the earned income tax credit. They're not terribly far away from those kinds of administrative questions, but not if you've got fewer than 25 days and even fewer on the floor to do something about this. I would still, though, say you've outlined the parameters of a deal that would not be terribly difficult to put together in the tax writing committees. It involves changing some statutory language around, inserting new amounts, those kinds of things that are not beyond the capacity of the Senate Finance and House Ways and Means committees, even at this point. If you were to pair it with something like the restoring the full expensing of research and development, which is very critical, that involves basically, and I looked at this, it's not like I've memorized it. I just looked at the Tax Cuts and Jobs Act. You could theoretically change Section E, subsection E of Section 174 with the effective date and give yourself 2 more years. Now, you could even do that retroactively, and you'd have to do very little else to the tax law to make that happen. The child tax credit change is a little more complex, but not terribly so. And I think the question remains here, how do we convince members of Congress that a deal is within their grasp? I know that National Taxpayers Union has a special section on its website urging folks who visit our site at ntu.org, see our initials for NTU, that sign right back there, ntu.org, where you can learn more about what the parameters of a year-end tax deal would look like and how you can contact your members of Congress. I know that Bipartisan Policy Center kind of has a different model, a different approach, but you're talking a lot with staff members on the inside right now of how they might be able to come together. Maybe for those who are participating in this webinar who are on Capitol Hill, let me provide this assurance. We're here to try and get a deal together that appeals to Democrats as well as Republicans. We're not about obstructionism. I know Andrew isn't about obstructionism.
Well, and no, it's well put, Pete. And I would just add, I see, I see these discussions around a potential bipartisan tax deal in 2023 or in early 2024 as something of a trial run or a test run for 2025. Of course, each party in Congress hopes that they have a trifecta come 2025, that they have the White House, that they have both chambers of Congress, and those are plausible scenarios for either party. We could certainly have government trifectas. I continue to believe that the most likely outcome is some form of divided government. And I don't know who's in the White House. I don't know who controls the House, who controls the Senate. But I do believe it's marginally more likely than not that we have divided government in 2025. And what that means is that both parties are going to have to negotiate on major tax policy expirations for the first time since the Obama era, since early in President Obama's first term when the Bush tax cuts were expiring. And this is it's a muscle. These involve muscles that I think members of Congress and have not flexed in a long time when it comes to bipartisan tax policy making. That's not to say it's been a barren wasteland over the last 10 to 15 years. You look at, for example, a lot of the tax policies enacted during the COVID pandemic were passed on a bipartisan basis in the CARES Act, for example, in March 2020. So there is, and I will say, I want to add, it has been encouraging, at least just what I've read in media and in public reports. It is encouraging to see that it appears Chairman Jason Smith at Ways and Means and Chairman Wyden at Senate Finance seem to have, they're talking to each other. They seem to have a productive working relationship, and that is a great thing, because not every chairman and not every chairman of opposite parties or chairman and ranking members necessarily get along in Congress, but it seems like they are having a really productive working relationship, and that hopefully is setting a foundation and laying the table for there to be productive bipartisan tax policy discussions in 2025, because it is so important for the stability and the permanency of our tax code to get both parties to eventually agree on permanency of some of these policies, figuring out what stays from TCJA, what goes, what gets reformed, what might get added, over the course of this debate. This work needs to happen now, because TCJA touches just about every part of the tax code. And while it's been encouraging to see the relationships that are forming between the two parties, there's obviously a long way to go to the end of 2025, and so. Working that muscle in service of a smaller bipartisan deal over the next few months, I think would be a great trial run.
Yes.
But we'll see where it goes.
Yes. Learn how to crawl before you walk or run. That's not a bad adage to take to heart for our legislative process. We do have an interesting question here, and normally I keep confidential anyone who asks a question, but I think being a member of the policy community, it's important to mention where this came from. And the question is obviously directed to Andrew. Can you expand a bit on the relationship between the phase-in rate and employment incentives as you see them? One of our colleagues at the R Street Institute had research earlier this year that showed it'd be possible to balance employment incentives and targeting to low-income families without actually reducing employment. So please enlighten us.
I will try to get at what I think the questioner is asking, and I'll just note that I think the world of R Street, have a number of friends over there, so it's always nice to hear from someone at a fantastic organization like R Street. So I think you can get creative with the phase-in and refundability rules, specifically to essentially balance work incentives within the credit. Imagine a scenario where we're increasing the phase-in rate from 15% to 30%. Well, that means that more parents will phase into the whole credit quicker, which means that you will have some parents, probably, I'm just doing the math off the top of my head, so forgive me if I'm wrong, probably in the $20,000 to $30,000 range, who are actually fully phased into the credit, receiving more in credit dollars than they otherwise would under current law. And so theoretically, if they're receiving more credit dollars for the same amount of income, our research on work incentives suggests that could marginally decrease the incentive to work, and could reduce the number of people in the workforce. But if you balance that, for example, with moving to full refundability of the credit, so moving from current law $1,600 to $2,000, you're actually balancing out. You're actually allowing people who otherwise would be capped at $1,600 per child to be earning more in child tax credit for each child, of $400 more specifically. And so that you would imagine would marginally increase work incentives. I'm not explaining it well because it's very wonky, and I hope that I did the question justice. But you can essentially take the phase-in rate on the one hand and refundability on the other, and sort of balance those two against each other to balance your negative and your positive work incentives in the phase-in portion of the credit, so that your net employment effects are fundamentally neutral. And I apologize to anyone listening if I misspoke in trying to explain that live.
Oh, no, I don't think so. I think you did that very eloquently. And you wouldn't be able to escape a webinar with me without having to discuss some of the administrative aspects, because I love talking about administrability. I sense even outside the legislative process, there may still be an opportunity here, given the fact that the IRS received a huge commitment of resources, $80 billion since reduced by the Fiscal Responsibility Act, to do all kinds of modernization and so-called enforcement initiatives, many of which we don't agree with at NTU. But you made some interesting recommendations through BPC. This was in September of 2022. So by you, I'm referring to BPC, not you personally, about enhancing the administration of refundable credits. That means providing better resources to the low-income tax clinics and the volunteer income tax assistance program, setting up a special office within the IRS to tackle the unique administrability issues of what are primarily social policies. And also, and I agree with this one wholeheartedly, which is to do more personal one-on-one outreach to those who might be under examinations who claim child tax credits or earned income credits, because there's suspicion in the communities that benefit from these credits. There's also language barriers that can pop up in many cases. They are, in short, very poorly served by the current outreach efforts of the service. And frankly, I think you could use some of the IRS's resources right now. I mean, the commissioner could actually, as part of his title, says commit to pushing forward some of those initiatives and utilizing some of those resources. Any comments?
Yeah, I just say, even if NTU and BPC might take a different approach to the $80 billion that was provided the IRS in last year's Inflation Reduction Act, I think we both see the opportunity in using a portion of those funds, whether it's in taxpayer service, although as we've discussed, Pete, I certainly worry about the burn rate on the taxpayer service funding in the IRS account that will run out of it soon before all of these good and ambitious customer service initiatives of the IRS can be implemented and or improved upon. But there's perhaps you can even get creative with some of the enforcement and operations support funding to say, rather than have to undergo expensive or time consuming or sometimes frightening audits for taxpayers who are, for example, improperly claiming CTC or EITC or claiming too much of a given credit. Can you communicate with those taxpayers beforehand to prevent problems before they start? And can you creatively use some of the enforcement or operations support funding for that purpose? But no, thank you for bringing up our 2022 report. There are a number of recommendations there. It's called Claiming Complexity, and you can find it on our website, bipartisanpolicy.org. Number of recommendations in that report to improve communication and outreach between the IRS on the one hand and taxpayers on the other. I think a couple of important points to take away from that. You hit the nail on the head, Pete, that there are communities in our country that I think face more obstacles and challenges than others when it comes to interacting with the IRS, filing their taxes, claiming credits and deductions for which they are eligible. So acknowledging those disparities, acknowledging those challenges, and meeting those taxpayers where they're at, thinking about third party organizations or entities that can communicate with taxpayers in those communities. If you think about social clubs or even religious institutions, faith leaders, like who on the ground in these local communities can actually most effectively and most frequently communicate with folks on a day-to-day or a week-to-week basis to ensure that they understand the tax system better, that they have help filing their taxes. For a lot of us, filing our taxes is It's not something most people look forward to, and for some, it's certainly more complicated than others. But for a lot of people, we are helped along by being able to purchase TurboTax or H&R Block or other tax filing software each year and file our taxes that way. That expense is not can serve as can even be a barrier for some low income folks. And so thinking about how we meet those people where they're at, how we better communicate and coordinate at the federal level, the state level, nonprofits, the private sector, it all needs to come together. And so I'm glad you brought up that report, because we should always be, and I know you always do this in your, you've always done this in your career, Pete, we need to center the taxpayer, the proverbial taxpayer, in all of these discussions, because it's not just dollars and cents on a budget spreadsheet. It is about the people, the tens of millions of people who are filing their taxes, paying their taxes every year, and the many millions who access these credits because they're eligible for them, and for whom these credits play a large role in being able to afford the necessities of life. So it is critically important for these taxpayers.
Yeah, absolutely. So we're coming up at the top of the hour. I'll give you 45 seconds. I'll split the difference between half a minute and a minute, Andrew, to make any point that you'd like to make or any question you'd like to answer that I didn't ask.
I will just hammer home the point, Pete, that whether it's on the child tax credit or research and development expensing or any other tax policy issue that's going to come up between now and the end of 2025, we believe that durable and lasting policy change comes from bipartisan cooperation and consensus building between the two parties. And in many parts of our policymaking and our political process right now in the United States, that is missing. We are working at the Bipartisan Policy Center every day to foster these conversations and to foster this bipartisan goodwill. It needs to happen in the tax policy space as well, and it needs to happen before and leading into 2025, because it is going to be, as Chairman Smith calls it, the Super Bowl of tax, and we need to be ready for the game.
Okay, I certainly could not agree more with that sentiment. I'll close by saying, look how fast this hour went. And for those in Congress who might have watched this, don't let the hours pass by so quickly that you can't get a deal done, either well before the end of 2023 or perhaps into the very early part of 2024. For more information on what we're doing about that, check out bipartisanpolicy.org, correct?
Yep.
And NTU, our initials for National Taxpayers Union, NTU.org. And let me thank all of you again for participating in this webinar, especially our supporters. You're the ones who make this possible, who allow us to have these discussions with Washington, D.C. It is absolutely vital that taxpayers have a voice in this process and a seat at the table, and you're giving us that voice and that seat. So thank you, and until we discuss another weighty matter again, take care, and we'll see you soon.